Well, I absolutely think when you look at the near-term market action last week, particularly around concerns with the brief yield curve inversion we saw, that certainly is one of the things setting the tone for risk assets right now. But that being said, largely, we have a similar view to what the administration is saying when you see some of the underlying strength in the U.S. economy right now.
So let's put it this way. Is the recession fear overblown, given that brief yield curve inversion that you stated? Because there is a feeling right now that the economy in the U.S., not robust, but good enough from a relative standpoint to the rest of the world.
I think there's certainly a rising risk of recession that's crept into the conversation today and right now, particularly as it concerns trade policy, because that is one area where, at least so far, we've seen more of an impact on sentiment than we have on real growth. But there could be significant damage if all the proposed tariffs and the escalation of the conflict continues.
Over the course of the past couple of weeks, CNBC viewers have noticed that we've put the yields in that little thing at the bottom of the screen there. We'll show you exactly what's happening with the 2-year, the 10-year, the 30-year. Is it fair to say that interest rates are the key focus among traders of all asset classes right now?
I think that's certainly been the primary focus over the last few weeks, because that's the one area of the market where we're certainly getting a more unusual signal than what we've been seeing in, let's say, credit markets, currency markets, or even the stock market, which, while you've seen some volatility, isn't significantly below recent highs. So I think that's one area that's signaling to us there could be concern on the horizon. But again, we'd need to see much more persistent signaling from the Treasury market, particularly around a yield curve inversion, for several months before we start to get really concerned.
Can we talk about that credit versus Treasury side of things? Because that's one place where many traders have told me, you're not seeing signs of stress. The 30-year at record lows, yeah, signs of stress. The 10-year, 2-year inversions and the generally lower curve, signs of stress. But high yield and investment-grade bond markets are not showing that kind of fear right now. Is it fair to say they've got it right?
Absolutely. You know, I think that's a really interesting signal is when you look at what is corporate America saying, or what are you hearing from the bond market, particularly on that investment-grade credit side and high yield side. And spreads have been really well behaved through this most recent sell-off. So that to us says there's still underlying strength in corporate America and particularly corporate earnings looking forward. So that positive signal to us is one reason we think the cycle can continue.
All right, so let's assume right now that the markets do still have a constructive bias towards them to the upside, assuming that.
Yeah.
If that is the case, where are the parts of the market that are going to be under the most stress, and where are the ones that are poised to outperform in this current environment?
Well, I think naturally, coming back to that trade conversation, some of those companies that are more levered to either global supply chains or trade are going to see stress over the next few months, particularly around uncertainty, planning for the future, capital expenditures. All of those things are usually directly impacted by some of the trade conflict that we're seeing. That being said, when we look at the broader market, we're still seeing the market pay up for companies who find ways to grow even in a slow growth environment. So favoring kind of those growthier names over value even at this point in the market.
Any sectors in particular?
We still like some of those sectors like tech that have that ability to continue to grow their revenues at a faster pace than headline GDP.
What do you avoid?
Well, I think when we're looking at from an avoidance standpoint, some of those defensive sectors still aren't appealing to us. So things like utilities, where we're just not seeing the right conditions now to get super defensive on the equity side.